In May 1986, Ivan Boesky stood at a podium at UC Berkeley and told a crowd of business graduates that greed is healthy. He told them you could be greedy and still feel good about yourself. 5 months later, Boesky was facing a $100 million penalty from the SEC. While he was preaching the virtues of self-interest to students, he was secretly negotiating a settlement for some of the largest securities violations in history. Regulators didn't start with Boesky. The investigation actually began with a single broker at Merrill Lynch who noticed something impossible: a series of trades that were perfectly timed, over and over again across different accounts. Detectives traced these suspicious wins away from Manhattan and into a secretive bank account in the Bahamas. It was a fake name account at Bank Lou, shielded by some of the most protective banking laws in the world. These mirrored trades in a tropical haven were the first loose threads in a billion-dollar conspiracy, a syndicate that would eventually lead investigators back to the most powerful offices on Wall Street. Bahamian secrecy laws initially blocked the investigation. U.S. authorities had no legal standing to force the bank to reveal who was actually behind the trades. The SEC bypassed the offshore blockade by waiting. They tracked the Bahamian bank's portfolio manager and served him with a subpoena the moment his feet touched U.S. soil. Facing immediate prosecution, the bank manager surrendered a specific name: Dennis Levine. He was a managing director at Drexel Burnham Lambert, one of New York's most aggressive firms. Legitimate risk arbitrage is a bet on whether a merger will actually close after it's been announced. Levine removed the risk. He used a network of bankers to feed him tips before the news was public, buying into companies while their prices were still flat to capture the guaranteed spike of a public announcement. Levine's win rate was so perfect that local bank employees in the Bahamas started secretly copying his trades. That extra, uncoordinated volume is what finally created the ripples that the SEC noticed. Levine was the intelligence gatherer, but he lacked the massive capital required to maximize these secrets. He was a scout, funneling information to a much larger operation. After his arrest, Levine immediately implicated the man who was actually weaponizing his tips, Ivan Boesky. Boesky was paying Levine a 5% cut of his profits for the inside information. To keep the payments off the books, the two men settled their debts with suitcases full of $100 bills. The final piece of the cartel sat in Levine's own office building at Drexel. It was the head of the high-yield bond department, Michael Milken. Milken was the architect of the junk bond. He created a system that allowed corporate raiders like T. Boone Pickens to borrow billions in high-risk debt, giving them the capital to launch hostile takeovers against massive, established companies like Phillips Petroleum. Because Milken couldn't legally trade on the deals he was financing, he parked stock with Boesky. Boesky would buy the shares on Milken's behalf and then funnel the profits back to Drexel through millions in fake consulting fees. They had effectively closed the loop. They controlled the financing, the inside knowledge, and the market execution, ensuring they never had to take a real Wall Street risk. To the public, Boesky's $100 million settlement looked like a wealthy man buying his way out of a prison sentence. In reality, Boesky traded his freedom for a recording device. He spent months wearing a wire, turning his entire network into a map of recorded evidence. Those tapes triggered a cascade of indictments. The syndicate collapsed node by node as confessions dismantled the operation. Boesky was sentenced to 3 years. Michael Milken, who faced 98 separate counts of racketeering and fraud, eventually served 22 months and was banned from the securities industry for life. The era of the unchecked billion-dollar hostile takeover came to a halt, as the SEC used these convictions to reassert control over the market. The syndicate was broken, but the blueprint they created for leveraged corporate raiding remained. It proved that systemic greed always leaves a paper trail, but only if there is someone willing to follow it to the end.